Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by LatinXcellence. Visit LatinXcellence.com. That's LatinX, CELLENCE.com or LatinXmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to episode 99 of the On My Way to Wealth podcast. My name is Luis and I'm your host. Thank you all for tuning in. So I'm sure the title has some of you wondering if I fell off my chair and bumped my head. But I promise it will make sense. So why wouldn't you want a huge tax refund, right? It sounds like now during tax season, especially everybody's like getting ready to file their returns and hoping for a huge tax refund. Well, let me tell you, I promise it's going to make sense. Let me tell you why that is. But before I tell you that, let me give you some quick tips about exactly how much taxes you're supposed to have withheld during the year in order to avoid a penalty. And then once we clear that, we're going to get into why you don't want a huge tax refund. You're supposed to have a certain percentage of taxes withheld throughout the year from your paycheck or by making estimated payments so that when you file your tax return, you're not penalized for under withholding your taxes. So I'm going to give you the formula. It's pretty simple. It's called an estimated tax safe harbor rule or the safe harbor rule. And here's what that means. You're supposed to pay either 90% or more of your total tax from the current year's return or 100% of your taxes from the prior year, unless you owe less than $1,000 in after-tax withholdings and credits. Then you don't have to worry about that. But for the most part, most of us are going to fall in that category, right? If you make over $150,000 or $75,000 if you marry, file, and separate, then it's slightly more. It's either 90% of the tax shown on the current year return or 110% of your tax from the prior year. So what I mean by tax is literally when you calculate your taxes due on your 1040, there's a line item. It's going to say total tax. And then the difference between that and what you had withheld, typically most people withhold more than they have to pay during the year. And then they get a refund, right? It's an overpayment of taxes. Usually that's what a refund is. It means that you overpaid your taxes and then you're getting some money back. And obviously there's some credits that some people qualify, but ultimately, whether it's via credits and withholding, if you have more due to you than you had withheld during the year, than your taxes are due, during the year, then you're going to get a refund, right? So it's considered an overpayment. It actually says that word in the IRS 1040. When you file your taxes, you take a look at that line item. So let me give you an example so that it kind of makes a little bit more sense. Let's say your tax bill for this year is $10,000, right? You calculated your income, your 1040 is ready, and it says total taxes, $10,000. Now we're going to look at how much money you had withheld to see whether or not you're due a refund or you owe further money, right? So if you withheld less than your total tax, then you owe. If you withheld more and or have credits, then you get a refund. So based on a $10,000 tax bill for this year, you're supposed to pay the lower of 90% of your total tax, which in this case is $9,000, right? 10,000 divided by 90% or multiplied by 90%, or 100% of your last year's. So let's say that you happen to make more money from last year. You actually had a tax bill of $8,000 last year. And this year you have a tax bill of $10,000. So if you paid at least $8,000, which is 100% of your last year's tax bill, even though you owe $10,000 this year, you would still be okay because you withheld at least 100% of last year's tax bill, right? So that's the way you look at it. It's either 100% from last year or 90% of this year, whichever is lower, right? Now, if you made over $150,000, this is your adjusted gross income, or $75,000 or more as a person that's doing marry, file, and separate, then you have to do either 90% or 110% from the prior year. So in this scenario, it's either $9,000, which is 90% of this year's, or 110% from last year's, which was $8,800, right? So just to give you that comparison, right? That way you know whether you fall under the safe harbor. So as long as you fall under the safe harbor, then you don't have to worry about owing a penalty for under withholding. Now, here's where the planning comes in, because when you think about it, a lot of people love getting a huge tax refund. And obviously that sounds great, but I want to give you some perspective, a different point of view so that you think about it differently, right? So think about what I said before. An overpayment throughout the year then results in a refund when you file your taxes. So that means that you're overpaying your taxes throughout the year, having more withheld in order to get a refund. And that's fine. Obviously, there's nothing wrong with getting a refund. But the alternative is, what if I adjust my withholding so that I get a lesser refund and I get a bigger paycheck? What can I do with that money? So I want you to kind of start thinking about it that way. And the reason I started with the safe harbor rules, because I don't want you to withhold so little that you actually under withhold and then penalize yourself. So this is where some of the planning goes in. I'm going to share the IRS tax withholding estimator calculator, which you can do yourself. But I highly recommend that you work with a professional that has a tax background, whether it's a tax preparer or financial planner, so that you can do some proper planning throughout the year. This is one of the things that I do with my clients when we do tax planning, because we want to take a look at what can we take advantage of during the year. You know, a lot of people say to me, it's an interesting perspective that when you're getting a tax refund, is as if you lent the government money for a year with 0% interest, and it's interesting to look at it that way, right? Because you're like, that means, all throughout my paycheck, I was having more taxes taken out. The government kept it for the whole year. And then sometime between like January and April of the following year, they give it back to me with 0 interest. It's one way of looking at it. Very interesting. Now, there are some ways that you can avoid the penalty as well. I'll give you just a couple of them. So if you had no tax liability the prior year and you're a U.S. citizen and your prior tax year covered a 12-month period, you don't have to worry about it in order to, as far as like getting assessed a penalty for underpayment of taxes. If you experience any unforeseen, uncommon, noteworthy events, such as a casualty or disaster, that's an exemption as well. Also, if you retired at age 62 or older during the current or prior year and had reasonable cause for not making the payment, is another one. If you became disabled during the prior or current tax year. And also, there are some self-employed people that don't have taxes withheld throughout the year because they get money directly from either a consumer or a business that they bill, right? For example, somebody that is a real estate agent or an Uber driver, you get a 1099, you don't have any taxes withheld from your money that you earn. So you have to send estimates throughout the year. Typically, those are due 4 times a year. It's April 15th, June 15th, September 15th, and January 15th of the following year, where you should be sending quarterly estimated payments to the IRS and the state, perhaps, if you live in a state that has state income tax, in order to avoid a tax penalty. There is an exemption for self-employed people that have seasonal income. So you could do what they call an annualized income installment method. So there are people out there that perhaps, for example, a tax preparer, if you prepare taxes during tax season, you have like that core period where you make an X amount of money, but not so much throughout the year. If you're a real estate agent, you may have several months that go by where you don't have sales, but then you have a huge quarter, right? So then you would apply the annualized income installment method. I'm not going to get too deep into that, but I just wanted to throw out some of the exceptions out there that apply. But ultimately, just know as a general rule, you have to have that the minimum 90% of your total taxes so that you're not being penalized, or 100% from last year, right? And 110% if you make 150 or more, or 75,000 or more for married, filing separate. So now let's say we cleared that bar. So what are our options? What are the best ways to use the increase in cash flow? Think about it this way. That's one thing. For example, let's talk about debt. Let's say you happen to have credit card debt. Does it make sense for you to get a lesser paycheck and a bigger refund, and then throughout the year, using the money that you have to start sending payments to these high interest credit card debt or loan? would it make more sense to adjust your withholding so that you had less taxes taken out? And obviously you want to do it in a way so that you still have enough so that you do not break that safe harbor rule and you don't get penalized. But can you find that balance where you then increase your paycheck because you have less taxes withheld and then reroute those funds to start paying off your credit card throughout the year, as opposed to waiting until the end of the year to get a refund to then send it to your credit card? You can save yourself some interest and some time by doing this strategy. Think about if you don't have an emergency savings, so you want to wait until you get your tax refund to then add that to your savings. You could have been adding that throughout the year and be better prepared for any type of emergency that may have happened, right? So that you build that cushion in your savings account. And then let's talk about investing. If you look at it from a purely interest rate of return and also taxes, so I'll give you a few different strategies. So one of them is investing in an individual retirement account, right? An IRA, whether it's a Roth IRA or a traditional IRA. Should you wait until you get your refund to then look into investing one of these? There's something that a common phrase that people say, you want time in the market, you don't want to time the market. And all that means is you don't want to have to worry about when the market is going up or down and trying to like time it perfectly to buy low and then sell high. But you do want time in the market. So if you get the money throughout your paycheck, you're better off over the long term taking that money and investing it, as opposed to getting 0% of that money while the government holds it and gives it back to you at the end of the year and then invest it, right? So you want more time in the market. Now, what about your 401k? I just did something with a client the other day that it was a huge impact. They were saving some money outside of their retirement accounts at work into just a regular brokerage account. And then we did some calculations and said, what if we take that very same money and invest it pre-tax? And because of their high tax bracket, and they were paying federal, state, and other municipalities as well, because where they live, there were some charges as well for the municipalities. They were able to use $13,000 that they were putting away and actually put away the max to the 401k, which is $20,500. They got an additional $7,000 in investing power because they invested that money pre-tax as opposed to getting taxed on the money and then invested it. So it was a great exercise because not only did we save money in taxes, we were able to invest $7,000 more than they were investing without having less income at the end of the paycheck. You know, it was super powerful. So now you have an extra $7,000 per year compounding over time, right? So these are the kinds of things that you should be looking at during the year. So now as you file your taxes, if you're getting this huge tax refund, think about it that way. You know, speak to your financial planner and say, hey, maybe we should make some adjustments so I can put this money to work throughout the year for me, as opposed to waiting towards the end. Because the power of compound interest, the power of saving money on taxes, you know, if you're going to do like a pre-tax strategy, you can put the money in a health savings account. You can put the money in a Roth IRA. I mean, there's many places to do this depending on your circumstances and your goals. But the trick is having your money work for you, as opposed to just waiting to get this big lump sum at the end of the year. Now, some people do prefer the high tax refund because of the way that they have done their budget, and that's fine too. But I want you to just be purposeful, very have intent behind it. So let me give you some examples. I have clients that wait till the end of the year to have this big tax refund and then use that to pay large ticket items that are not part of their monthly budget allocation. Like, for example, there are clients that pay like their homeowners insurance or their auto insurance every 6 months or every year, like this big bill. That way they're not making monthly payments. It might save a little money and they don't have to worry about it impacting their cash flow. That's fine. You know, you might want to put it into your vacation fund because maybe every summer you take a big vacation and you just use the tax refund for that. That's fine too. You know, as long as you're being strategic about it. But aside from those large ticket items into your budget, like if you're not using that strategy and it's just like you just blindly just having whatever taxes come out of your paycheck and then get whatever refund, right? You can be a little bit more strategic about it and put that money to work for you ahead of time. So just be sure that you're still withholding enough so that you're not falling at a point where you're under withholding and then having a penalty, because I don't want you to do that. Obviously, this is very dynamic and it's not something that you can time it perfectly where you're going to have like literally $0 due and zero refund. There's always going to be either a refund or an amount due, but you can do it where maybe your refund isn't as huge so that you can take the bulk of that refund ahead of time and give yourself a raise during the year and reroute those funds to something that is going to be more beneficial for you down the line, whether it's investing, paying down debt, or saving to beef up your emergency fund. Definitely consult with a tax professional, financial planner, so to see if this strategy works for you. But I think it's worth changing your mindset around that. Looking at it, I hope now you don't think I'm crazy, and maybe even entertain the possibility of not wanting a huge tax refund either. So I hope you find this information useful. If you have any questions, any suggestions, and so on, as always, feel free to send me an email at luis@onmywaytowealth.com. And I will see you on episode 100 coming up next week. Can't even believe it. Thank you all for tuning in, and I hope you have a great day. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.